Cheddar Amigos, we are riding a streak of 8 profitable swing trades. So in this video, I want to break down just how simple implementing this supply and demand trading strategy can be. We're going to break down the last 3 setups for you here, the logic behind them, and why they have been so successful. And by the way, all of our discussions are completely free to join. The link for the Discord is going to be in the description below as well. Or you can choose to support the channel and get access to all of our live trading streams and alerts. I don't sell any courses, all trading information, tutorials, tips, strategies, that can all be found for free online, but supporting the channel does get access to me 24/7. All right, let's get into it. Step 1, always look at the macro picture, regardless of any trade setup that you may be looking at. What is the fundamental and the technical picture telling you right now? After you do get that understanding, you can then break down into individual mega cap names, big cap names, or even some of the mid caps. For the purpose of this strategy, we're not going to be looking at momentum names or penny stocks because they trade under a different set of rules. When the overall fundamental and technical thesis is bearish, we're of course going to be looking at more bearish and short setups. On the flip side, when the picture is bullish, things are bright and rosy. The fundamental picture for the market looks great. The technical picture looks great as well. We're going to be looking at bullish setups. It's very simple. Now, breaking down these 3 trades, the fundamental thesis right now tells us that there is uncertainty in the markets. We've got rate hike headwinds, continued inflation concerns, and the FOMC meeting that is looming coming up on March 15th. So, uncertainty. That is what the markets hate the most. And when there is uncertainty, there is almost surely going to be an opportunity for a short somewhere in the market. For the macro trade, we alerted the SPY short at the triple top. You can see that very clearly over here at the top of this shelf. It's a very, very simple SR flip. So ignore the red. It is going to be the gray bar over here, also seen by the very clear volume nodes on the right. At the top of this range, you could see very clear distribution happening from previous accumulation. So this over here, this is going to be accumulation taking place over the course of about 2 to 3 trading sessions. Now, technicals are always going to be an indicator of the underlying market behavior. So this market behavior is telling us that where there was previous demand, there were shares being accumulated, there are now sellers. That is supply that is being distributed within the market. Now let me pan into the 5-minute chart so you can see closely, because with that in mind, we did take the SPY short here on Thursday, February 10th. This is going to be the 455 put expiring February 16th. It's the following Wednesday. We just wanted to add some extra time to have cushion instead of YOLOing basically the Friday weekly expiring the next day. This is going to reduce your overall risk, but also reduce your reward. Now, throughout the day, this already performed pretty good for us, but the following day, Friday, the SPY dumped over 18 points, and that was an incredible 4% move. It allowed for a 150% profit on the latter half of our contracts. Really, this actually ended up running north of 300%, and if you're looking at the weeklies, of course, these would have made probably well north of 1,000%. But again, we're not looking at maximizing our risk with the weekly contracts here. Now, to give you another couple examples with individual names amidst overall broader market bearishness, let's take a look at Moderna. This is an individual name that popped up into a similar accumulation range, and it was ready for a supply dump, aka distribution. If we pan back to the prior week, we could see some accumulation taking place in the 152 range here, and that accumulation getting dumped once, twice, and 3 times. Now, typically, the more and more supply gets tested, eventually the sellers are going to dry up, and eventually that supply will get cracked to the upside if there are enough buyers. However, in this example on February 16th, we did alert that supply was getting retested here, and we took the February 18th weekly lotto for the 150 put at $3. Now, it goes without saying that volatility is absolutely critical in order for these options trades to pan out, and you're going to have a much safer time reducing your risk when you are trading with shares as opposed to options contracts. The following morning, this is February 17th, we did get the morning dump. These contracts basically opened up 50% in the first 5 to 10 minutes of trading back into this pocket where we were looking to take our profits. Again, a very simple example of supply being distributed, and you've got a very nice dump from 152 down to 147. Another fantastic example that we executed on was Rivian. This is a beautiful setup we had. It popped up into the $70 shelf. I'll show you the 15-minute chart so you can see it a little bit more clearly over here. Step one, we've confirmed that there is overall a broader fundamental weakness and technical weakness in the markets. So now we're going to look for a bearish setup. We do find that Rivian has accumulation occurring here in the $70 through $72 range. So prior, when Rivian hit $70, you've got buyers that are stepping in thinking that $70 is a nice, safe area to buy shares. However, Rivian cracks $70, and all these guys here, they're now caught holding the bag. So what does market behavior tell us when this $70 accumulation gets retested? Well, the $70 test gets dumped once, doesn't quite reach here, gets dumped again, and now we've got an opportunity here today to short the $70 level. Zooming into the 5 minutes so that you can see the picture extremely clearly here, but this is a beautiful example of supply being tested and shares being distributed. As we get confirmation over $70 that this is about to roll over, we alert an entry on the lotto. February 17th, we alerted for the February 18th. So those are the weeklies expiring the following day. A lot of risk here. So typically you do want to size small when the risk is higher. The 70 puts were going for $2. These are implying a break even of $68 by the expiry the following day. However, we've got a fantastic breakdown on the distribution here, all the way back to the opening price, $65. These contracts are now going for roughly $6, netting you a 200% return within about 4 to 5 hours. Sometimes the swing is going to pan out in the same day like we saw here. Sometimes it's going to take a day, and maybe sometimes it'll take several days. But once you really understand the simplicity of supply and demand trading, shorting supply, going long off of demand, so potentially going long off this bottom over here. And hey, you could even play the supply breakouts. What happens when price comes above supply? Well, you've got the breakout long. You could then play the breakdowns. What happens when price comes below demand? You've got further breakdown, further opportunity to short. Once you focus on those small to medium sized consistent wins, it's really going to change the way that you see trading instead of constantly looking for those home run opportunities. So that's going to be it. A very simple approach to supply and demand trading. Always look at the macro picture and then drill down into individual names. Let me know if you enjoyed this type of content in the comments below. Follow me on Twitter for more frequent chart analysis and updates. You could also join our Discord discussions completely for free. All of the information is going to be in the description below, and I'll see you all in the next one.